Is Estée Lauder finally rising after years of struggle? Is it the great recovery or just a momentary glow? And why they are launching new doublewear foundation? Just a few years ago, they were one of the most powerful players in the beauty industry. Then came the slump, declining sales, struggles in China, inventory surpluses, and a change in leadership. The stock price plunged by more than half. But what about now? In the latest ELC fiscal report, published in February 2026, the new CEO, Stéphane de La Faverie, who took charge in January 2025, expressed confidence that the restructuring plan, Beauty Reimagined, is delivering the desired results. For the first time in 4 years, the reports show improved financial indicators. For the second quarter of fiscal 2026, Estée Lauder reported a 6% increase in net sales, reaching $4.2 billion. Organic net sales grew by 4%. The company's gross profit also saw a 6% increase, amounting to $3.2 billion, with a gross margin of 76.5%. Stock prices on the NYSE have begun to recover from the significant losses following the 2022 slump. The stock is currently trading between $90 and $120, compared to a peak of $370 in 2022. While it has shown growth since April 2025, this recovery has been marked by episodes of sudden collapses. Does this mean the crisis within ELC has been rectified? Is a major recovery underway, or is it just a momentary improvement? How launching a new version of doublewear foundation will help? I will show you how they built their empire and exactly what went wrong. I will explain the Beauty Reimagined plan and whether investors truly have a reason for optimism. Let's answer to the first question. How Estée Lauder built a beauty empire? The Estée Lauder Companies is a global leader in the beauty industry with sales $15 billion, and it holds the third position after L'Oréal $44 billion and Unilever $26 billion. ELC has 20 plus brands and operates in 150 countries in 4 major product categories. To secure its position as the first largest player in the market, ELC has come a long way since its founding in 1946. Over the decades, the company has implemented various strategy shifts and transitioned from family-led management to hiring external CEOs following the pandemic crisis. Let's examine the strategies ELC has utilized through the years. Founders era from 1946 to 1980s, with Estée and Joseph Lauder in charge. When Estée Lauder started out, the American cosmetics industry was dominated by Elizabeth Arden, Helena Rubinstein, and Revlon. However, she differentiated herself by focusing on personal relationship with women and promoting her products among socialites through free product samples. Estée Lauder was the face of the brand and the lead R&D inventor, while her husband Joseph Lauder was responsible for the operational side of the business. At the time, ELC strategy focused on launching prestige skincare via department stores, personal demos, and gifts with purchase. Their strategy was built on the intersection of luxury and relationship-based sales. Which iconic brands were launched back then? First, Aramis, launched in 1963, a prestige men's fragrance and grooming brand. Second, Clinique, launched in 1968, the first dermatologist-created, allergy-tested, and 100% fragrance-free cosmetics collection. Estée Lauder made a genius move and partnered with leading New York dermatologist, Dr. Norman Orentrait, to develop Clinique formulas, while former Vogue beauty editor Carol Phillips leads the launch of products. That was outstanding PR move that repaid greatly. Estée and Joseph Lauder managed to diversify brand portfolio within growing niches without diluting core glamour. After that came Leonard Lauder, who was in charge from 1982 to 1999. He was a son of the founders. This was the time of massive global expansion and finally breaking into the Asian market. Leonard focused on building a powerhouse brand portfolio through smart acquisitions and transformed Estée Lauder from US-centric family firm into a global corporation via his General Motors of Beauty strategy. Under Leonard Lauder's leadership, the company's revenue soared from under $1 million in the late 50s to $15 billion. One of the most defining moments in Leonard Lauder's tenure came in 1995 when he took Estée Lauder Companies public. The company's stock surged 33% of the first day of trading in New York, underscoring investor confidence in the brand growth prospects. In 1993, he made a strategic move and started selling in mainland China. He pioneered portfolio strategy, acquired Bobbi Brown, La Mer, MAC, Jo Malone London, and more. He took an innovative step and in 1996, ELC launched its first e-commerce sites for Clinique and Bobbi Brown cosmetics. And interesting fact is that Leonard Lauder is also credited with popularizing the lipstick index, a theory suggesting that lipstick sales often rise during economic downturns as consumers seek affordable luxuries. After Leonard, his son William P. Lauder took charge of ELC and led the company until 2009. He was a third generation of family leadership. His years at the company was all about scaling up. William pushed for massive digitalization, expanded the portfolio even further, and professionalized management. He oversaw acquisitions of innovative complementary brands, fill gaps in haircare, professional makeup, and luxury. One of his biggest creations was launching Origins in 1990, the first wellness brand sold in US department stores. Origins combines the power of plants and science with high-performance products. He introduced innovative store-within-a-store concept as a selling strategy. And in 2005, he started collaboration with Tom Ford, Gucci creative director, and launched luxurious fragrances and cosmetics, which was a huge success. He acquired Bumble & Bumble, Smashbox, and licensed Michael Kors. After William, ELC introduced the first non-family CEO, Fabrizio Freda, who was appointed in 2009 and maintained in charge till 2025. He introduced new plan, the Mission Control Profitability Framework, emphasizing focus on 10 to 12 core brands with 10x10 growth targets, double-digit growth in key categories and regions, aggressive merger and acquisitions, innovation, and expansion into high-growth channels like travel retail, Asia, and digital. He pushed travel retail, doubling sales pre-COVID, e-commerce 20% plus of revenue by 2020s, and Asia-Pacific dominance through acquisition of innovative regional brands like Dr. Jart. During the 2010, the company adds a dose of Hollywood glamour to its portfolio. ELC acquired LA-based brands, the instantly transformative skincare brand Glam Glow and the playful cosmetics line Too Faced. He acquired also Le Labo perfumes, Becca Cosmetics, The Ordinary, and Dr. Jart. Fabrizio Freda raised market capitalization from $50 billion to $100 billion. Under his control, ELC became one of the top 3 global beauty giants, with growing and diversified portfolio. Everything was going well, until the COVID crisis hit. And the very same model that carried them to the top later became their greatest risk. Now let's talk about the downfall of Estée Lauder, when the success formula stopped working. For decades, the Estée Lauder Companies operated like a finely tuned machine. But the financial facts of the last few years tell a story of a sudden and painful wake-up call. The company witnessed a staggering erosion of its market capitalization and persistent revenue declines that shook investors' confidence to its core. In 2021, the stock price hit approximately $370. At this point, ELC market capitalization was at a record $130 billion. In 2022, downfall started, and in the late 2024-25, share prices dropped to $80, with only $39 billion market capitalization. What were the reasons of such decline? There have been three general reasons: geographical, cultural, and operational. The main issue was the company's heavy dependence on China. For years, the Chinese market was ELC's golden goose, but the pandemic changed everything. As the rest of the world began to reopen, China prolonged lockdowns, created a major bottleneck that prevented growth. This was compounded by turmoil in travel retail duty-free system that once acted as ELC's most profitable showroom, but suddenly fell silent as global travel patterns shifted. Additionally, ELC lost to local Chinese brands that are innovative and affordable. Moreover, North America sales slowed down. Inflation caused overall drop in consumer spending. As I mentioned, it wasn't just geography. ELC also failed to notice shift in consumer preferences and market dynamics. For example, a global consumer slowdown meant shoppers were tightening their belts. Gen Z behaviors shifted. Younger audiences began value transparency and vibe over traditional prestige. A wave of indie and digital-first brands emerged, capturing the spotlight with agility and authentic social-first marketing. E-commerce like Amazon and TikTok dynamics growth happened. ELC lost touch with evolving consumer preferences and market changes. They were slow with adaptation to trends and exploration of niche categories. Without novelties, they were falling down and has no chance to catch attention of young public. What is more, ELC struggled with excess inventory and high operational costs. Recognizing that the old ways were failing, the company appointed new president and CEO, Stéphane de La Faverie, in January 2025. This move signaled a definitive new strategic shift, but the market has reacted with uncertainty. Investors are holding their breath, waiting to see if a company built for a world of department stores, high-spending Chinese tourists, and traditional loyalty will survive. New CEO Stéphane de La Faverie introduced a restructuring plan called Beauty Reimagined, but the ground is shifting fast, and it leaves us with question. Can ELC's old-school setup actually keep up with how the market works today? Now let's go through Beauty Reimagined. Main points of the rescue plan. Point first: deep cost reduction, trimming a global operation that had grown too heavy and too slow. Second point: portfolio optimization, re-evaluating ELC's massive list of brands to focus on the winners and move away from the laggards. Point third: structural lean down, implementing painful layoffs and simplifying a complex corporate hierarchy to speed up decision making. Point fourth: inventory crisis management, fixing the broken supply chain with AI contribution to cut out products that plagued their balance sheet. Point fifth: digital and data revolution, shifting heavy investment into data-driven marketing, AI supported, to finally catch up with the digital-first competitors and better target consumers. The target is clear: reclaim lost margins and restore the profitability that once made ELC the envy of Wall Street. But is this a true transformation of the business model or just a desperate fix for operational failures? To find out if the Beauty Reimagined is working, let's look at the latest fiscal report, published in February 2026. Here are crucial facts. Net sales increased 6% to $4.2 billion. Organic net sales increased 4%. Gross margin expanded to 76.5%. Adjusted operating margin expanded to 40.4% from 11%. Operating income showed a significant improvement, rising to $401 million from a loss of $580 million in the previous year. Now see regional perspective. In mainland China, the company reported double-digit retail sales growth for the second consecutive quarter, driven by brands like La Mer, Tom Ford, and Le Labo. In Japan, the company saw share gains in makeup and fragrance categories, led by MAC and Bobbi Brown Cosmetics. In the US, the company gained volume share in total prestige beauty, with significant contribution from Clinique and The Ordinary in the skincare segment. The company also launched several new products and campaigns, including limited edition holiday collections and innovation in skincare and makeup. In terms of distribution, Estée Lauder continued to expand its consumer reach through various channels, including Amazon and TikTok Shop. The company also announced a strategic partnership with Shopify to modernize its digital technology infrastructure. In regard to merger and acquisitions and innovations, ELC made its first investment in a Latin American brand, acquiring a minority interest in the Mexican luxury fragrance brand, Chinu. Estée Lauder also launched the Jo Malone London AI Scent Advisor for personalized fragrance recommendation. Now let's look at the ELC condition through product categories. Skincare net sales increased 6%, primarily driven by growth from La Mer, Estée Lauder, and The Ordinary. Makeup net sales decreased 1%, primarily driven by Estée Lauder, partially offset by MAC. Fragrance net sales increased 6%, driven by high single-digit growth from Tom Ford and Le Labo. Haircare net sales returned to growth, increasing 5%, primarily driven by The Ordinary and Bumble and Bumbles. While the first half of the year showed strong results, ELC is staying realistic about the tough economy and ongoing challenges in certain parts of the business. As a result, they are narrowing sales targets, expecting organic net sales growth to range between 1% and 2%. The company anticipates adjusted operating margin to be between 9.8% and 10.2%. What is worth to emphasize in the context of strategic decisions, voting power is still in family hands due to dual share class system, so the family decides about the business development directions. Perspectives look quite optimistic, but for better understanding we need to consider challenges ahead ELC. There are a few recent headlines that is worth noting. First, ELC is suing Walmart for allegedly allowing counterfeit luxury fragrance to be sold on its marketplace, including other prestige brands under its umbrella, like Tom Ford, La Mer, and Clinique. This isn't just legal, it's about brand trust. In prestige beauty, perception matters, and fake products dilute legitimacy and erode consumer confidence. Second, ELC was fined $548,000 by a Canadian court after pleading guilty to violating the Canadian Environmental Protection Act by selling eyeliner products containing substances often called forever chemicals without proper government notification. Third, ELC is selling Dr. Jart, Too Faced and Smashbox, although ELC does not break down the performance of each individual brand. Too Faced and Dr. Jart were both identified last year as underperforming for the company in its annual results. The decision is a part of Profit Recovery and Growth Plan, known as Beauty Reimagined. And fourth challenge. In the latest fiscal reporting, ELC's makeup net sales declined, with Estée Lauder brand makeup impacted by estimated returns of the existing Doublewear Stay in Place foundation, ahead of a next-generation Doublewear launch in early 2026. The iconic Doublewear foundation has been reformulated and relaunched, drawing mixed reactions from consumers from Gen Z that expects multifunctional products. It is a reminder that even beloved products must evolve or risk losing relevance. It's time for the summary and to address our main questions. Is Estée Lauder finally rising after years of struggle? Is it in a great recovery or just a momentary glow? And why they are launching new Doublewear foundation? On one hand, Estée Lauder remains a titan with a legendary portfolio of brands and a restructuring plan that is finally cutting through the corporate noise. The potential for a massive bounce back is there. The numbers in early 2026 are starting to prove it. But the world ELC dominated for decades has vanished. The market today is unrecognizable compared to 10 years ago. Today prestige is no longer a golden ticket to growth, and the luxury label doesn't carry the same weight it once did. Perhaps most importantly, Gen Z doesn't buy legacy. They buy emotions. They don't care how long a brand has been on their mother's vanity. They care about is winning the conversation right now. If Estée Lauder truly returns to the summit of the beauty world, it won't be because of its history or its famous name. It will be because they proved they can evolve and adjust to the new world. The real challenge is whether a legacy company can successfully adapt its operation to the era of TikTok and social commerce, or if its traditional model has simply become outdated. Time will tell.